As you'll remember, there's a couple different types of adjusting journal entries. When we think about them, we can think about kind of prepayment adjusting journal entries. Like, for example, we prepay for an insurance policy and it's used up over time. But we can also think of in terms of accruals, right? And then accruals is going to be the focus of this video. And ultimately, accruals is itself going to be split into two parts. And we're going to have accrued revenue, and then we're going to have accrued expenses. Okay. Now I'm going to give some examples of each and show you how you'd go about making the adjusting journal entries with respect to accruals. So let's start with accrued revenue. Okay, so you might say, okay, well, why would we have to make an entry for some kind of accrual to revenue? Well, it's very similar to the prepayment issue, right? So time passes, and some things you're just not going to make some kind of entry every single day. So let's take an example as interest. Let's say that you have some money in the bank and you actually go and you earn some interest, and so January 31st 2016 you get a letter from your bank saying that you've earned $15 of interest. Okay, $15 of interest, and they just went and took that and they just added cash to your bank account, right? They just put it right in there. So you say, okay, well, what's happened here? Well, now I have to make an adjusted journal entry to reflect this increase in cash, right? So say, okay, when I find out about this, or at the end of the month or quarter, whatever, you get this, and you say, okay, I'm going to adjust my cash account here, up 15. And then you also have to adjust the revenue, right? And that's where this accrued revenue comes in. We have revenue that we weren't recognizing as it happened, right? It's not like a sale, right? A sale, you make the sale, you recognize the revenue right then, right? But this is different, right? This is interest, and it was happening every single hour of the month or the quarter, whatever. And then we're just at some point just going to have to make an adjustment, this adjusting journal entry to just say, okay, we've got some interest here. So we go ahead and we just make this entry to reflect the fact that now we've had $15 of interest revenue. Now, so we can have these accrued, revenue type issues, but it can also be accrued expenses. So let's think about this. So also you could have accrued interest expense, right? If it was interest expense rather than revenue. But let's use something a little bit different that happens quite often for firms. You might have a situation where, let's see in this example, so let's say that December 31st is your firm's fiscal year end. That's when they close the books. And December 31st happened to fall, it fell on a Wednesday. Right? So what could be the problem with that? Well, if you have workers working Thursday and Friday, and then they worked Monday, Tuesday, Wednesday, then you've got an issue where they've only worked 3/5 of the week, but maybe they don't get paid on Friday. So they're paid on Friday, but they've worked Monday, Tuesday, Wednesday as of December 31st. You see, they've already worked 3/5 of the week, but just because they didn't get paid on Friday doesn't mean you haven't actually incurred an expense, right? So you've incurred an expense for that 3/5 of that week, whatever those wages are going to be, even though you haven't paid it yet. You've still incurred an expense, and you'd be understating your expenses in your financial records if on December 31st you didn't make some kind of adjusted journal entry to go ahead and reflect this fact that these people have worked a part of a week. They've worked a small portion of a week. Okay, so now we need to make some kind of journal entry. So we're going to say, okay, December 31st, 2016, we're going to make an entry to reflect this wages expense or salaries expense, whatever you want to call it. We'll call it wages expense. Now, you haven't actually paid it yet because it's not going to be paid till Friday. So what do we credit? Well, we're going to credit an account called wages payable. So even though you haven't paid this, you're basically saying, okay, it's year end, right? And we've had these workers have done the work. Let's say it's $700. That's the value of 3/5 of a week or something like that. You go and you estimate it and you say, okay, they've earned $700 of wages, haven't paid it yet because they would get paid on Friday, but it's year end, we're closing our books, we need to make an adjusting journal entry to reflect the fact that these people have earned $700 of wages. So that's an example of an accrued expense that you would need to make an adjusting journal entry for.